So, you want to own a prison, not run one for the government, not manage a facility on someone else's dime. Own one. Land, buildings, contracts, cash flow, all of it yours. On paper, it sounds like the safest business in America. Your customer is the government. Your product is a bed. Your revenue is locked in, usually for years at a time, sometimes with a guarantee that you'll get paid whether that bed is full or empty. No inventory that spoils. No fashion cycles. No competitors showing up next door with a lower price and better service, because in most cases, there's no competitor next door. Just walls, contracts, and a check that shows up every month from a government agency. That's the pitch. That's the fantasy that has pulled billions of dollars of investor capital into this industry over the last 40 years. Here's the part that fantasy leaves out. This is also one of the strangest, most politically exposed, most operationally fragile businesses in the country, a business where the thing that keeps you profitable is the same thing that can end you overnight. A single election, a single new law, a single bank deciding your industry is now too toxic to lend to. By the end of this video, you'll understand exactly how the private prison business actually makes its money, why it looks so much simpler than it is, and why an industry that pulled in over $4.5 billion in combined revenue in a single recent year can still feel, to the people running it, like standing on ice that's slowly cracking. Let's go inside it. Picture the pitch deck. It probably looks something like this. You're not selling a product people have to be convinced to buy. The government has already decided it needs to detain people for crimes, for immigration violations, for 100 legal reasons that have nothing to do with you. You're just offering to do it cheaper and faster than a state government can build and staff a facility on its own. Your customer isn't fickle. A county government or a federal agency doesn't switch vendors on a whim, chase a rival on price, or get seduced by a competitor's ad campaign. Once you're the operator, switching costs are enormous. Moving a population of 1,000 incarcerated people to a different facility, under a different contract, run by a different company, is a logistical and legal nightmare nobody wants to repeat. And the numbers, from the outside, look almost boring in how stable they are. Two companies, CoreCivic and the GEO Group, control the overwhelming majority of the private corrections market in the United States. In a recent year, their combined revenue crossed $4.8 billion. That's not a scrappy niche industry. That's a duopoly the size of a Fortune 1000 company, built entirely on a business most people assume is small and regional. This is where the fantasy locks in. Recession-proof demand. A government customer that can't easily leave. Two dominant players splitting a market with brutal barriers to entry. It reads like the safest asset class in America. So why does an industry with those characteristics also carry some of the highest reputational risk, the tightest financing access, and the most contract-dependent revenue of almost any sector in the country? Because the simple version people believe is missing the actual mechanism that makes the whole thing work. And the mechanism is stranger than almost anyone expects. Here's the reframe. A private prison operator isn't really in the business of incarceration. Incarceration is the visible output, the actual product being sold. The thing that makes the entire economics work is a financial guarantee wrapped inside a real estate and staffing operation. Look at how many of these contracts are actually structured. It's not the government pays you for every person you hold. In a large share of contracts, researchers who've studied hundreds of these agreements put the number at roughly 2/3. There's a clause that guarantees the operator gets paid for a minimum occupancy level, regardless of how many beds are actually filled. The most common threshold is 90%. In some states, Arizona, Louisiana, Oklahoma, Virginia, that number climbs to 95, even 100%. Some Arizona contracts have gone even further, locking in payment for the entire facility, full or not, for the life of the deal. Sit with that for a second. Imagine a hotel chain that convinces a city government to guarantee it 90% occupancy every single night for the next 20 years, whether tourists show up or not. That's the closest real-world comparison, and it's not an exaggeration. One critic of the practice made almost that exact comparison, joking that Marriott would love that deal too. That single clause is the actual engine of this business. It converts a volatile, headline-driven, politically unpredictable population, how many people get arrested, how many get detained, how long sentences run, into something closer to a fixed income bond. The company isn't betting on crime rates. It's betting on contract terms negotiated years in advance. And that reframes everything about what owning a private prison really means. You're not managing a facility that succeeds or fails on operational excellence. You're managing a long-duration government obligation, collateralized by beds, that keeps paying out even in years when almost nobody is inside. That's the first real moment in this business. But it raises an immediate, uncomfortable question. If the state is on the hook for near full occupancy no matter what, who exactly makes sure those beds stay full? We'll come back to that. First, let's talk about what it actually costs to get into this business in the first place, because the barrier to entry is far more brutal than the pitch deck admits. A medium-sized correctional facility isn't a warehouse with bars bolted on. It's one of the most expensive categories of real estate to build per square foot in the entire commercial construction industry. You need reinforced structural security throughout: walls, fencing, perimeter detection systems, controlled access sally ports, surveillance networks that never go dark, redundant power systems for when the grid fails, and medical infrastructure that meets the same regulatory bar as a small hospital, because legally, you're responsible for the health of every person inside. A facility holding a couple thousand people can run into the hundreds of millions of dollars before a single person is ever admitted. Then there's licensing. You don't build first and figure out compliance later. Every jurisdiction has its own accreditation requirements, staffing ratios, medical standards, and inspection regimes, and failing to meet them doesn't just risk a fine. It risks the contract that justified building the facility in the first place. And here's the barrier almost nobody talks about, the one that quietly keeps new competitors out more effectively than any regulation. Financing has become nearly impossible to secure. Starting several years ago, a wave of major banks, some of the largest financial institutions in the country, announced they would no longer lend to private prison and detention companies at all. Investment funds began screening the sector out entirely on reputational and ESG grounds. For an industry that depends on long-term debt to build $100 million facilities, that's not a minor inconvenience. That's the credit market closing a door that used to be wide open. So picture the actual entry cost today. Hundreds of millions in construction and compliance costs, a multi-year approval and accreditation runway, and a shrinking, increasingly reluctant pool of lenders willing to finance any of it. This is why, decades after the industry was created, it's still effectively a two-company market. It's not that nobody else wants in. It's that almost nobody else can get in. The barrier isn't a patent or a brand. It's capital access itself, and that scarcity is exactly what protects the incumbent's margins. Which brings us to the part everyone actually wants to know. Once you've cleared that wall, how does the money really work? The base layer is the per diem, a daily rate, paid per person held, negotiated directly with the contracting government agency. It sounds simple. It isn't, because the real profit engine isn't the base rate. It's what sits on top of it. Start with the occupancy guarantee we already covered. That's the floor. It's the reason revenue doesn't collapse in a quiet year. But the real acceleration comes from a completely different source, which government customer you're serving. Immigration detention has quietly become the most profitable line of business in this entire industry, and the shift has been dramatic. At one major operator, revenue tied to a single federal immigration agency more than doubled in the space of a year, from roughly $120 million in one quarter to nearly $245 million a year later. At the largest player in the sector, that same federal contract now accounts for well over a third of total company revenue. Why is immigration detention so much more lucrative than standard state corrections? because state prison per diems are often negotiated years ago, capped by tight state budgets, and politically difficult to raise. Federal immigration contracts, especially during periods of enforcement expansion, tend to come with higher rates, faster contract growth, and far less price resistance from the customer, because the federal government, unlike a cash-strapped state legislature, can move billions of dollars toward detention capacity almost overnight when policy shifts. That's the real profit center hiding beneath the visible business. The facility gate you'd photograph for a documentary, the fences, the guard towers, that's just the delivery mechanism. The actual profit engine is a portfolio of government contracts, each with a different customer, a different rate, a different growth trajectory, and dramatically different political durability. And there's a second, quieter revenue layer most people never think about at all. Everything that happens around incarceration. Phone calls home, priced far above market rate. Commissary purchases. Money transfer fees for families sending funds to an incarcerated relative. Transportation contracts for moving detainees between facilities. Reentry and halfway house services after release. One major operator even runs its own prisoner transport subsidiary as a distinct business line. None of that shows up in the word prison. All of it shows up on the income statement. So the honest answer to how does the money really work is this. You are running 3 businesses stacked inside one building, a real estate and infrastructure business, a government contracting business with a guaranteed floor, and a captive consumer services business where the customer, quite literally, cannot walk away. That last one is uncomfortable to say out loud. It's also why margins in this industry can look so different from almost any other regulated sector, which makes the next question even sharper. If the floor is guaranteed and the ancillary revenue is nearly captive, why does anyone in this business ever lose money? Because the guarantee only protects revenue. It does nothing to protect the cost side. And the cost side of running a prison is where weaker operators quietly bleed out. Start with labor, because it's the single largest and least forgiving cost in the business. Correctional staffing is dangerous, high turnover, and chronically hard to fill, and the incentive structure of a for-profit operator points in exactly the wrong direction. Cutting staffing ratios cuts costs immediately. It also raises the risk of exactly the kind of incident that ends up in a lawsuit, a lost contract, or a congressional hearing. That trade-off has already played out in real facilities. At one privately run correctional center, a former guard described staffing ratios of fewer than 1 officer for every 100 incarcerated people during his years there, a ratio public sector facilities in the same state generally didn't operate under. The math behind that gap is brutally simple. Fewer staff means lower payroll means higher margin, right up until the moment it means a riot, an escape, a death in custody, or a wrongful death lawsuit that erases years of profit in a single settlement. Then there's litigation exposure, which in this industry isn't a rare tail risk. It's a routine cost of doing business. Deaths in custody, medical neglect claims, suicide prevention failures, transport incidents. In one recent stretch, a single company faced Senate scrutiny after 2 separate detainee deaths within months of each other, one during a transport by its own subsidiary, another a suicide at a facility that had already recorded multiple prior suicides going back nearly 2 decades. Each of those isn't just a human tragedy. It's a balance sheet event, legal costs, settlement exposure, reputational damage that can jeopardize the next contract renewal. Add regulatory compliance costs that never stop ticking, inspections, accreditation renewals, medical staffing minimums, use of force reporting, all of which cost money whether the facility is full or nearly empty. And then there's the cost nobody budgets for until it hits them. Financing cost itself. Remember the banks that pulled out of lending to this sector. For the operators still standing, that scarcity of capital means higher borrowing costs on whatever debt remains available at the exact moment when facilities need renovation, expansion, or refinancing. Here's the uncomfortable truth sitting underneath all of it. The occupancy guarantee protects you from an empty building. Nothing protects you from a badly run one. This is where the business turns genuinely fragile, not because demand disappears, but because the thing propping the whole model up is political, not economic. Trap 1. Policy dependency. This industry's single largest growth engine right now is immigration enforcement policy, a policy set by whichever administration currently holds power and reversible by the next one. When one company's federal detention revenue can double in a single year on an enforcement surge, the honest flip side is that it can just as easily collapse on an enforcement reversal. A business that size, built on a policy lever instead of organic demand, is a business built on sand that happens to look like bedrock right now. Trap 2. The capital markets themselves have turned against the industry. When major lenders and institutional investors screen an entire sector out on principle, that's not a temporary headwind. That's a structural ceiling on how much this industry can ever grow, no matter how strong demand gets. You can have a fully booked facility and still struggle to finance the next one. Trap 3. Contract concentration. A duopoly sounds like safety, but it also means each company's fortunes are tied to a small number of enormous contracts. Losing one major state contract or one federal agency relationship isn't a rounding error. It can be a double-digit percentage hit to total company revenue overnight. Trap 4. And this is the one that separates strong operators from failing ones. Incident risk compounds. One serious death in custody, one escape, one exposed, doesn't just cost a settlement. It can trigger a state legislature to cancel a contract, a city council to ban private detention outright, or a bank to formally exit the relationship. In this business, reputational risk and financial risk aren't separate categories. They're the same category wearing two names. Put all four together and you get the real definition of this business. An asset that looks like a monopoly-protected bond, but behaves like a leveraged bet on the next election cycle. Colorado is the clearest real-world proof of how this mechanism actually plays out. In the early 2010s, Colorado's crime rate had been falling for years, down roughly a third from its peak. Under normal market logic, that should have meant shrinking demand for prison beds and shrinking revenue for the private facilities housing them. Instead, the opposite happened. A private operator running 3 facilities in the state had already negotiated occupancy guarantees into its contracts. As the prison population fell, the state didn't reduce reliance on those private beds. It prioritized filling them first, ahead of its own public facilities, specifically to avoid paying penalty costs for empty guaranteed beds. Even with crime falling, the state ended up paying millions of extra dollars because the guarantee structure made empty private beds more expensive than full ones. Fast forward to the present, and the pattern hasn't disappeared, it's intensified. Those same Colorado facilities have continued to run at or near capacity, generating tens of millions of dollars in revenue from the state within a single 6-month stretch in a recent year. This is the entire tension of the business in one example. From a distance, it looks like the state is choosing to fill private prisons. Up close, it's the contract making that choice for them, because once you sign a guarantee, how many people are actually incarcerated stops being the variable that determines whether the beds get filled. That's the mechanism. It's also exactly the mechanism drawing the most political fire, which is the risk every operator is now living with. In a good year, this business is one of the highest margin, most defensible cash flow machines in corporate America. Federal enforcement policy expands. A major operator's revenue from a single federal customer more than doubles in 12 months. Profits at that same company jump nearly 70% year over year. Stock prices spike the moment election results signal a friendlier policy environment is coming. Occupancy sits near the guaranteed floor or above it. Ancillary revenue, calls, transfers, transport, rides along for free. In a bad year, the same business looks almost unrecognizable. A change in federal enforcement priorities can shrink a contract that took years to build. A state legislature under public pressure votes to phase out private prison contracts entirely. Several states have already done exactly that. A wrongful death lawsuit ties up capital and management attention for years. A bank that already refused to lend you now refuses to renew an existing credit line. Occupancy guarantees still pay the floor, but the floor was never designed to cover the cost of a 5-year legal battle. The unsettling part is that both of these scenarios can happen to the same company, in the same facility, within the same decade, sometimes within 18 months of each other. That's not typical volatility. That's a business where the swing between a great year and a genuinely threatening one is decided almost entirely outside the company's own operational control. Strip away the politics for a moment and look at the pure economic shape of this business, because it teaches something that applies far beyond prisons. Any business built on a government guarantee looks safe right up until the government decides it isn't obligated to keep guaranteeing it. The occupancy clause that protects private prison operators from empty beds is the same category of instrument as a government-backed loan guarantee, a subsidized utility contract, or a regulated monopoly franchise, an arrangement that converts political will into cash flow. That conversion works beautifully as long as the political will holds. It becomes the single point of failure the moment it doesn't. And there's a second lesson sitting underneath the first one. Businesses that profit from a captive customer, someone who legally, physically cannot walk away, accumulate a specific kind of long-term risk that a normal consumer business never faces. Normal companies lose customers when they behave badly. Businesses with captive customers instead accumulate lawsuits, investigations, and public backlash, and eventually lose their license to operate instead of losing individual sales one at a time. The bill still comes due. It just arrives all at once, years later, as a canceled contract or a state ban instead of a slow erosion in market share. That's the real story private prisons tell about modern capitalism. Some of the most stable-looking cash flows in the entire economy are stable only because a government promise is doing the heavy lifting. And government promises, unlike market demand, can be rewritten by the next election. So, do you still want to own a private prison? You'd be buying into one of the only businesses in America where your biggest customer is legally obligated to keep paying you even when your product sits empty. You'd also be buying into a business where a single incident, a single election, or a single bank's policy memo can undo a decade of profit in one news cycle. That's the real tension this entire industry lives inside, not whether demand exists, because it almost always does. The real question is whether the thing propping the business up is a market or a promise. And promises, in this business more than almost any other, have a way of getting rewritten by people who were never in the room when the original deal was signed.